What I'm about to explain is the difference between protecting wealth and slowly losing it without realizing it. There's a fundamental mistake that separates those who build generational wealth from those who work their entire lives and have nothing to show for it. And this mistake is so common, so deeply ingrained in our thinking, that most people consider it being responsible with money. They're wrong, dead wrong. Right now, as you're listening to this, millions of people are making a decision that feels safe, but is actually destroying their financial future. They're holding cash, not just emergency funds or short-term liquidity, but massive amounts of cash that they think is protecting them. Meanwhile, their purchasing power is evaporating like water in the desert, and they don't even know it's happening. Here's what wealthy people understand that most people don't. Cash is not an asset. Cash is a tool. It's a temporary parking spot for capital, not a destination. When you understand this distinction, everything changes. Your entire approach to money transforms. You stop thinking like someone who's trying to preserve what they have and start thinking like someone who's building what they want. I've spent decades studying wealth creation, analyzing market patterns, and understanding what separates successful investors from everyone else. And one pattern emerges consistently. Wealthy individuals don't hoard cash. They deploy capital into assets that work for them while they sleep. They understand that in our current monetary system, holding cash is not a neutral decision. It's an active choice to lose money. Let me break this down for you in terms that are impossible to ignore. If you have $50,000 sitting in a savings account right now, earning 2 or 3% interest while inflation runs at 5 or 6%, you're not being conservative. You're being reckless. You're guaranteeing a loss of purchasing power that compounds every single month. That $50,000 will buy significantly less next year than it does today, regardless of what your bank statement shows. But here's where it gets worse. Most people don't just hold cash for a few months, they hold it for years. They convince themselves they're being prudent while their wealth slowly bleeds away. They're so focused on avoiding the risk of market volatility that they accept the guarantee of inflation erosion. That's not risk management, that's financial suicide. The first way you're losing money by holding cash is through the inflation tax. This is the most insidious wealth destroyer in history because it operates silently. You don't get a bill in the mail telling you that your purchasing power decreased by 4% this year. You just gradually notice that everything costs more. Groceries, gas, housing, healthcare, education. The prices keep rising, but your cash in the bank stays the same number. The number might look stable, but what that number can buy is shrinking. Think about this historically. 50 years ago, a decent car cost $3,000. Today, that same quality vehicle costs $30,000 or more. What changed? Did cars become 10 times better? No. The dollar became worth significantly less. If your grandfather had kept $30,000 in cash for 50 years, he could buy one car today. If he had invested that money in productive assets, he could probably buy 10 cars or more. This isn't ancient history. This is happening right now, accelerating faster than most people realize. The monetary policy of the last several years has pumped unprecedented amounts of currency into the system. When you flood the market with money, basic economics tells us what happens. Each individual unit becomes worth less. Your cash holdings are being diluted by forces completely beyond your control. The second way cash destroys wealth is through opportunity cost. This is perhaps the most expensive mistake you can make because you're not just losing money to inflation. You're missing out on the compounding returns that productive assets generate over time. Every dollar sitting in a low-yield savings account is a dollar that could be working much harder for you elsewhere. Let me paint this picture clearly. Over the past century, the stock market has returned approximately 10% annually on average. That doesn't mean every year was positive, but over long periods, that's the historical pattern. Meanwhile, cash has returned essentially nothing after accounting for inflation. In many periods, cash returns have been negative in real terms. You're choosing the guaranteed loser over the historical winner. Consider this example. If you invest $10,000 in a diversified portfolio of productive assets earning 10% annually, in 30 years that becomes over $170,000. If you keep that same $10,000 in cash earning 3% while inflation runs at 4%, you're actually losing purchasing power every year. After 30 years, your $10,000 might have grown to $24,000 nominally, but it can buy what approximately $8,000 could buy when you started. You didn't just miss the opportunity for growth, you went backwards. This is why wealthy people think differently about cash. They see it as expensive. Every month that capital sits idle is a month of potential returns lost forever. You can't go back in time and invest money you held as cash 5 years ago. That opportunity is gone permanently. Wealthy individuals understand that time is the most valuable component of wealth building, and cash wastes time. The third way cash erodes wealth is through what I call the emergency fund fallacy. Financial advisors constantly tell people to maintain 6 months of expenses in cash for emergencies. While having some liquidity is important, most people take this advice too far. They end up with 2 years of expenses sitting in checking accounts because it feels safe. But what they don't realize is that this safety is largely an illusion. Real emergencies are typically medical issues, job loss, or major repairs. Medical emergencies are usually covered by insurance and payment plans. Job loss is best protected by having marketable skills and multiple income streams, not by hoarding cash. Major repairs can often be financed at reasonable rates. Meanwhile, you're paying a massive opportunity cost to self-insure against scenarios that may never happen or could be handled other ways. Here's what sophisticated investors do instead. They maintain some cash for true emergencies, perhaps 3 months of expenses, but they also build diversified portfolios of liquid assets that can be accessed if needed while still growing over time. A portfolio of dividend-paying stocks, bonds, and real estate investment trusts can provide both growth potential and access to capital when needed. These assets work for you every day, unlike cash sitting in a bank. Moreover, in most real emergencies, you need money gradually, not all at once. If you lose your job, you don't need 6 months of salary on day one. You need 1 month's expenses this month, another month's expenses next month, and so on. During that time, you can liquidate assets systematically if necessary, but in many cases, the income from those assets might be enough to sustain you without selling anything. The fourth way cash kills wealth is through behavioral traps. When you hold large amounts of cash, you start making irrational decisions based on fear rather than opportunity. You become obsessed with market timing. You convince yourself you're waiting for the perfect entry point, but the perfect moment never comes. There's always some crisis, some uncertainty, some reason to wait just a little longer. This behavior pattern destroys wealth because markets generally trend upward over time. While you're waiting for the ideal buying opportunity, prices continue climbing. You watch from the sidelines as assets appreciate year after year, always thinking the correction is coming tomorrow. Meanwhile, your cash earning 3% gets crushed by inflation running at 5%. I've seen this pattern repeatedly. People hold cash through entire bull markets, waiting for crashes that either don't come or are smaller than expected. When corrections do occur, they often freeze up anyway because now they're convinced things will get even worse. They end up buying nothing and holding cash through multiple cycles, missing decades of wealth creation. Wealthy people think differently. They understand that being in the market during the good years is more important than avoiding all the bad years. They know that missing the 10 best days in the market over a 20-year period can cut your returns in half. Since you can't predict which days those will be, the only rational strategy is to stay invested consistently. Cash holders miss all the best days by definition. The behavioral trap extends beyond timing. Large cash holdings make you conservative about everything. You start thinking like someone who has something to lose rather than someone building something great. You avoid calculated risks that could accelerate your wealth building. You pass up business opportunities, real estate investments, or stock purchases that could multiply your capital because you're focused on preservation rather than growth. The fifth way cash destroys wealth is the most subtle but perhaps most dangerous. It creates a false sense of security that prevents you from developing real financial resilience. When you have a massive cash cushion, you don't push yourself to increase your income, develop new skills, or build multiple revenue streams. You become complacent because you feel protected by your cash hoard. But here's the reality. In a world of rapid technological change and economic disruption, your biggest asset is your ability to generate income, not your ability to store it. The career that provides your paycheck today might not exist in its current form in 10 years. The industry you work in might be completely transformed. Your security doesn't come from having cash in the bank. It comes from having skills, relationships, and systems that can generate cash whenever you need it. Wealthy people understand this distinction. They invest in themselves constantly. They build businesses, develop expertise, create intellectual property, and establish networks that produce income streams. If one source of income disappears, they have others. If they need capital quickly, they can generate it or access it through various means. Their wealth is dynamic, not static. Meanwhile, people who focus primarily on accumulating cash often neglect these more important forms of wealth building. They think they're being responsible by saving money, but they're actually making themselves more vulnerable by failing to invest in income-generating capabilities. When their cash eventually runs out, which it will if they live long enough, they have no way to replace it. This is why retirees who rely solely on cash savings often run out of money. They calculated how much they needed based on current expenses and current purchasing power. But expenses rise with inflation while fixed cash amounts don't. They end up in their 80s with lifestyle they can no longer afford, forced to depend on family or government assistance. This tragedy is entirely preventable with proper understanding of how wealth actually works. Now let me explain what wealthy people do instead of hoarding cash. They understand asset allocation as a dynamic process, not a static decision. They maintain enough liquidity for immediate needs and genuine emergencies, typically no more than 3 to 6 months of expenses. Everything beyond that gets deployed into productive assets that can generate returns and hedge against inflation. The first category they focus on is dividend-paying stocks. These represent ownership stakes in real businesses that produce goods and services people actually want. When you own shares in a utility company, a food manufacturer, or a healthcare provider, you own a piece of operations that generate cash flow regardless of what happens to currency values. These companies can raise their prices when inflation occurs, protecting your purchasing power automatically. Moreover, many of these companies pay dividends that grow over time. You're not just preserving wealth, you're creating an income stream that increases annually. A company that pays a 3% dividend today and grows that dividend by 5% each year will be paying significantly more in 10 or 20 years. Your income keeps pace with or exceeds inflation without you having to do anything. The second category is bonds and fixed income securities. While these don't offer the growth potential of stocks, they provide stability and predictable income. In rising interest rate environments, you can lock in attractive yields for extended periods. When those bonds mature, you reinvest at whatever rates are available then. This creates a steady cash flow stream while preserving capital. The key is building what's called a bond ladder, where you have different bonds maturing at different times. This gives you regular access to capital while ensuring you're always earning competitive rates. It's far more sophisticated than keeping everything in a savings account earning whatever the bank decides to pay you. The third category is real estate and real estate investment trusts. Property has historically been one of the best hedges against inflation because rents and property values tend to rise with the general price level. When you own rental property or shares in REITs, you're getting paid from rent collection while building equity and appreciating assets. Real estate investment trusts are particularly attractive because they're required to distribute 90% of their income to shareholders. This creates high dividend yields, often in the 4 to 7% range, while still providing exposure to property appreciation. You get the benefits of real estate ownership without the hassles of being a landlord. The fourth category is international exposure and commodities. Different currencies and economies move in different cycles. When the dollar weakens, international investments often perform well in dollar terms. Commodities like gold, oil, and agricultural products tend to maintain their value during inflationary periods because they represent real things with intrinsic utility. This isn't about speculation or trying to time markets. It's about diversification across different asset classes that respond differently to various economic conditions. While cash loses value in all inflationary scenarios, a diversified portfolio of real assets can maintain or increase purchasing power across different environments. The psychological shift required here is significant. You have to stop thinking of investing as gambling and start thinking of it as business ownership. When you buy stocks, you're buying pieces of companies. When you buy bonds, you're lending money at interest. When you buy real estate, you're acquiring property that generates rental income. These are business transactions, not casino bets. The wealthy also understand the concept of productive debt. Instead of avoiding all debt, they use leverage strategically to acquire more assets than they could with cash alone. A mortgage on rental property, for example, allows you to control a larger asset while the tenant pays down the loan. The rental income covers the debt service while you build equity and benefit from appreciation on the full property value, not just your down payment. This is fundamentally different from consumer debt used to buy depreciating assets. A car loan or credit card debt works against you because you're paying interest on things that lose value. But debt used to acquire appreciating income-producing assets can accelerate wealth building dramatically. The key is ensuring the income from the asset exceeds the cost of the debt by a meaningful margin. Let me address the fear that keeps most people in cash. They worry about market volatility, about losing money if stocks go down or real estate values drop. These concerns are understandable but misguided. First, volatility is not the same as risk. Volatility is temporary fluctuation around a long-term trend. Risk is the permanent loss of capital or purchasing power. Cash feels safe because the nominal value doesn't fluctuate day to day, but the real value erodes constantly and predictably. A diversified portfolio of productive assets might fluctuate more in the short term, but historically preserves and grows purchasing power over longer periods. You're trading the certain erosion of inflation for the uncertain but historically positive returns of asset ownership. Second, wealthy people don't invest money they need next month or even next year. They maintain liquidity for short-term needs and only invest money they can leave alone for extended periods. This time horizon difference is crucial. Over 1 or 2 years, market movements can be unpredictable. Over 10 or 20 years, the pattern of wealth creation through asset ownership becomes much more reliable. Third, they diversify not just across asset classes, but across time as well. Instead of trying to invest a large sum all at once, they invest consistently over time through dollar-cost averaging. This reduces the impact of short-term volatility while ensuring they participate in long-term growth. When markets are high, their regular investments buy fewer shares. When markets are low, the same money buys more shares. Over time, this smooths out volatility while building substantial positions. The mathematical reality is undeniable. Over any 20-year period in modern history, diversified asset portfolios have outperformed cash by enormous margins. There has never been a 20-year period where cash outperformed stocks. Never. The longest bear market on record lasted about 3 years. If you can wait longer than 3 years to access your money, history suggests you're much better off in productive assets than cash. But here's what's really important to understand. This isn't about getting rich quick or making spectacular returns. This is about not getting poor slowly. Inflation is a wealth transfer mechanism that moves purchasing power from cash holders to asset owners. Every year you hold significant amounts of cash, you're participating in that transfer as a loser. You're giving your wealth to people who understand how the monetary system actually works. Central banks have made this clear through their policies. They want inflation. They target inflation rates above zero deliberately. They've told you explicitly that they plan to erode the purchasing power of cash over time. Yet millions of people continue holding cash as if it's a safe long-term strategy. It's not safe. It's guaranteed confiscation through inflation. The solution isn't complicated, but it requires changing your mindset about money fundamentally. You need to stop thinking like a saver and start thinking like an investor. Savers try to accumulate money. Investors try to accumulate assets that produce money. The difference is everything. Start by calculating exactly how much cash you truly need for genuine emergencies and immediate expenses. Be honest about this number. Don't inflate it because of vague fears or worst-case scenarios that probably won't happen. Then commit to investing everything above that amount systematically into productive assets. You don't have to do this overnight. You can dollar-cost average into your positions over several months to reduce timing risk. You don't have to pick individual stocks or try to beat the market. Broad market index funds give you instant diversification and market returns with minimal effort and low costs. But you do have to start. Every month you delay is a month of opportunity cost you'll never recover. The wealthy people I study don't have magical knowledge or insider information. They simply understand basic principles that most people ignore. They know that wealth is built through ownership, not employment. They know that inflation favors debtors and asset owners over cash holders. They know that time and compounding are more powerful than any individual investment selection. And they know that doing nothing with your money is actually doing something very destructive. Your financial future depends on understanding these principles and acting on them consistently. The monetary system we live in rewards asset owners and punishes cash hoarders. You can either work with that reality or against it, but you can't change it by wishful thinking or denial. The choice is yours, but the consequences are mathematical. Hold cash and lose purchasing power gradually but certainly. Own productive assets and participate in the wealth creation that has lifted living standards for centuries. The path forward is clear for anyone willing to see it. The question is whether you'll act on what you now know or continue doing what feels comfortable while your wealth slowly disappears. Time is running out. Inflation isn't slowing down. Asset prices aren't getting cheaper. The longer you wait to move from cash to assets, the more expensive that transition becomes and the more opportunity cost you accumulate. Wealthy people understood this years ago and positioned themselves accordingly. The gap between them and cash holders grows wider every day. Stop being the person who learns these lessons after it's too late to benefit from them. Start being the person who understands how money really works and uses that knowledge to build lasting prosperity. Your future self will thank you for making this shift or regret that you didn't. Either way, the choice you make now will compound over decades into dramatically different outcomes. The information is in front of you. The historical evidence is overwhelming. The mathematical reality is undeniable. What happens next depends entirely on whether you'll act with courage and conviction or continue down the path of comfortable financial destruction. Choose wisely, choose soon, and choose with full understanding of what's at stake.